And welcome back. Fannie Mae just announced their latest housing market forecast through 2024. They provided their forecast for home sales, housing starts, home prices, and mortgage rates, and of course, much more. But unlike their previous monthly housing market forecasts, they actually provide some context or some expectations of how our housing markets can be impacted by the bank failures of Silicon Valley Bank as well as Signature Bank as well. Fannie Mae is also predicting we're going to get into recession in the second half this year as well. So I have a lot to cover in today's video. Let's go ahead and dive right in. Again, this is just published today at the time of this video, which is March 24th. It says here, the banking system instability may prove as a catalyst for a recession in the US. So they're forecasting for a modest recession to begin in the second half this year. And you actually see that right here. So most people would define a recession as 2 consecutive quarters of negative GDP or gross domestic product. So look at this right here. For the second quarter of 2023, down 0.2%. Then in Q3, down by 1.3%. And then in Q4, down by 0.6%. Therefore, Fannie Mae is predicting for a modest recession in the second half of this year. They also mentioned that these recent events regarding these bank failures and also troubles by Credit Suisse is one of the main reasons why it's going to be a catalyst for us to get into recession. They also mentioned one of the main reasons as well is a lack of consumer confidence as well. So speaking of that, regarding our housing market, according to Fannie Mae's February survey, they say here housing sentiment returns to a near all-time record low amid affordability constraints and job security concerns. In this survey that was posted on March 7th, 44% of consumers who respond to the survey here reported it's a bad time to sell a home. Also, 24% expressed concern about losing their job over the next 12 months. Additionally, only 17% said it's a good time to buy a home right now. They also say here, while home sales experienced a large bump in February, if you guys missed my video on that, home sales for existing houses actually increased by 14.5% compared to January. So due to this large bump in February, that was due to a pullback in rates, of course. The ESR group, which is their economic and strategic research group by Fannie Mae, noted that recent mortgage application data suggests that last month's level of home sales will be temporary. So what they're saying here is that for February, we saw a large bump in home sales compared to January. I would say that's due to a pullback in rates, but also due to our seasonality of our housing market. Just like I mentioned in my video, that was based on a report from the National Association of Realtors and also a video I made about a week ago, right? In any case, they're saying here they're looking at mortgage application data, which suggests that the bump up in sales we saw in February is actually going to be temporary, and we're going to see a pullback in sales in March. They also expect home sales to remain subdued due to ongoing affordability constraints and, of course, this lock-in effect that current homeowners have because they don't have a lot of incentive to move, given the fact that a lot of people have rates of less than 4%, and of course, current rates are around 6.5%. So here's what they had to say regarding their housing market forecast. They actually revised upward total home sales for Q1 of 2023. However, but expect a larger contraction or decrease later this year. We expect total home sales, which by the way, that includes existing plus brand new home construction. So total home sales in 2023 to decrease by 18.4% from 2022. Their previous forecast was for a 17.6% decrease. Then in 2024, they're predicting a partial rebound regarding home sales in the US. It says home sales will rise 7.1% for the year of 2024. Their previous forecast was for a rise of 9.6% in 2024. Fannie Mae also provide a disclaimer regarding their interest rate forecast because they say here, it should be noted that our interest rate forecast was completed prior to the recent bank failure events. Thus, it does not reflect the sharp drop in rates that we saw over the past 2 weeks. Therefore, there's a downside risk in their mortgage rate forecasts. So in other words, rates could end up being lower than their forecast since their forecast was made before these bank failures. And on top of that, they recognize there could be an upward risk to home sales as well as mortgage originations. So in other words, home sales and the number of new loans to buy houses could end up being higher than anticipated due to the recent rate drop. Fannie Mae also provides some additional context regarding these bank failures and the effects on our housing market. It says housing activity generally experienced a bump up to start the year following a pullback in mortgage rates. Many homebuyers who have been waiting on the sidelines appear to have jumped in as existing home sales have increased by 14.5% in February, thanks to a new report from the National Association of Realtors. And this increase of 14.5% on a month-to-month basis, still down compared to 1 year ago, is more than they expected based on previous increases in mortgage application data. However, recent mortgage activity points to the level of home sales being temporary, and we expect lower numbers in March. Now here's where it gets really interesting in my personal opinion. It says we expect the recent banking turbulence, aside from affecting general macroeconomic growth, to have other effects on housing and mortgage activity as well. Number one, single-family mortgage lending in the jumbo market. Jumbo loans are more or less high loan balance loans. It depends on the county. It varies by the county. So for example, in the San Francisco Bay Area, for example, loans over around $1.1 million is a jumbo loan. And below that is a conforming loan balance. Any case, single-family mortgage lending in the jumbo market may tighten significantly, leading to fewer sales in related regions and market segments. Ongoing liquidity stress could limit home financing and therefore sales in those marketplaces that have a high amount of jumbo loans. As of February 2022, jumbo loans account for approximately 12% of all loans originated. So what comes to mind initially regarding this is that I think of markets in which they have high home prices, right? So in the San Francisco Bay Area, when you're talking about the median sold price in Santa Clara, San Mateo, as well as San Francisco counties, those have average prices or average home prices of around $1.5 to $2 million. Therefore, I'm guessing areas like the San Francisco Bay Area, potentially LA, for example, or New York City, could be negatively impacted by these bank failures due to what Fannie Mae has to say right here. Fannie Mae also predicts that construction activity could be hampered as well due to these bank failures as well. They said construction and development loans, both for single-family construction and multifamily, are heavily financed by regional and community banks. So small and mid-sized banks account for approximately 2/3 of total bank finance commercial real estate loans. We should therefore expect a drag or a decrease on housing starts and multifamily residential sales. And number three, mortgage rates are likely to pull back in light of the 10-year Treasury falling. If you guys all know, the 10-year Treasury note or the yield on that is closely matched to fluctuations in rates or mortgage rates. So because the 10-year has been falling, they're expecting that mortgage rates are also going to be at relatively low levels as well. Therefore, Fannie Mae is saying here this may add some short-term support for the spring home buying season, as buyers currently on the sidelines may look to take advantage of these lower rates, as others did at the start of the year when rates fell from their peak of over 7%. Now, having said that, even though we've seen this decrease in rates, which could potentially cause a short-term increase in demand, they also say here, regardless of how the banking turbulence plays out, we continue to expect home sales activity to remain subdued for the remainder of 2023. Even if mortgage rates were to pull back to 6%, by the way, at the time of this video, which is the 24th again, average 30-year fixed rates are around 6.4%. So even if mortgage rates pull back to 6%, affordability remains highly constrained. All right, let's have a look at Fannie Mae's latest housing market forecast for housing starts, home sales, home prices, and of course, rates as well. Let's first talk about housing starts. And housing starts are on a seasonally adjusted annualized basis here. Actually, all these metrics here are on a seasonally adjusted annualized rate. So housing starts, which of course includes single family plus multifamily, total housing starts for 2022 decreased by 3%. For single family, it decreased by 10.6%, but in contrast, for multifamily, that actually increased by 15%. But here's our forecast. This is a big change here. 2023, total housing starts to decrease by 25.6% compared to 2022. A giant decrease of single family as well as multifamily housing starts as well. Then look at 2024 though, because there's a rebound for single family. Single family, an increase of 12.5% in 2024 compared to 2023. In contrast though, multifamily, another decrease, down 14.5% from 2023. Now this section right here is a quarter by quarter change. So in 2022, every quarter decreased from the previous quarter regarding single family housing starts. Then another decrease in Q1 this year, another decrease in Q2 as well as Q3. Then in Q4, an increase. Then it increases throughout 2024 for single family housing starts. Now let's have a look at new home sales. New home sales in 2022 decreased by 16.9% from 2021. For existing houses, which is actually single family, condos, and co-ops, that decreased by nearly 18% from 2021. Now here's our forecast though. New single family home sales, it declined by 5.1% this year, and it decreased by 20.1% for existing houses on a year-over-year basis here. So a huge decrease of existing home sales in 2022, and their forecast calls for a giant decrease again in 2023. But in 2024, it gets reversed though. Look at this, an 8% increase for existing single-family home sales and a gain of 1.1% in 2024 for new single-family home sales compared to 2023. Also, when looking at single-family home sales for existing, look at this because they actually call for a slight decrease in Q1, followed by a decrease in Q2, then another decrease in Q3, and then an increase in Q4 of 2023. Thereafter that, they're calling for an increase every single quarter through 2024. By the way, I should have mentioned this earlier on, but for example, in Q3 of 2023, their forecast is calling for 4,008,000 existing home sales on an annualized basis. So these numbers right here are in thousands of units. I should say every single one of these numbers here are in thousands of units. So when talking about housing starts for single family, this is 769,000, and of course not 769. I also want to share their real estate market predictions for home prices as well. And that's based on their HPI or their home price index. Look at this, because starting in Q2 this year through the entire year of 2024, they're calling for a decrease compared to the previous quarter for home prices. Home prices is based on their index that Fannie Mae has. But in 2022, they had a 9.2% increase in home prices. Look at this though, 2023 decreased by 4.2%. Then in 2024, compared to 2023, another decrease again, down by 2.3%. So that's their home price forecast through 2024. Let's have a look at their rate forecast as well, which is right here. So for Q1, they're calling for the average rate to be 6.4%, then it increased to 6.6% in Q2, hold steady in Q3, and then a decrease in Q4 of 2023. Then in 2024, their forecast is for a decrease in rates every single quarter. So for 2023, their forecast for the entire year is going to be at 6.5% for an average 30-year fix. Then in 2024, to decrease to 5.9%. And again, just a friendly reminder, this forecast based on rates is before the collapse of Silicon Valley Bank and of course Signature Bank as well. Therefore, a lot could change given the fact that rates have been decreasing ever since then. And with that said, please comment below your biggest takeaways from today's video. Also, if you guys got any value in this video, please hit the like button. I greatly appreciate that. Of course, I appreciate you. Also consider subscribing, of course, as well. I hope you guys have an awesome day. I look forward to seeing you on the next video.